The Employees Provident Fund is expected to declare a handsome dividend payout for 2021, ranging between 5.2 and 6%, according to Economists. According to Bernama, this is on the back of the fund's higher gross investment and better capital market performance. Bank Islam Malaysia Chief Economist Muhammad Afzanizam Abdul Rashid says the EPF's gross investment for the first 9 months of 2021 was already 7.7% higher year-on-year at 48.02 billion ringgit. Muhammad Afzanizam says that it should at the very least match the 2020 level, if not better. In 2020, the EPF declared a dividend of 5.2%, with a payout amounting to 42.88 billion for conventional savings and 4.9% for Sharia savings, with payout totaling 4.76 billion ringgit. Muhammad Afzanizam says the chance for a better dividend rate for 2021 would be higher should corporate earnings for the fourth quarter turn out better. Furthermore, the EPF had also been diversifying its portfolios into overseas markets, and incomes from foreign equities had made significant contribution to its total income, he notes. On special withdrawals under the EPF's Isina, Lestari and Chitra facilities, the Economist reckons that the withdrawals would likely not have a severe impact on the fund's dividend performance. He observes that the economy was able to grow in 2021 and the unemployment rate trended down to 4.2% in December 2021 from as high as 5.3% in the middle of 2020. Therefore, fresh contributions from EPF members, along with maturing investment assets, would help to offset the withdrawal trend. AmBank Group Chief Economist and Research Head Anthony Das says despite some domestic challenges, the overall performance of the local capital market was favourable, hence the dividend payout is expected to hover between 5.45 and 6%. Das adds that the coverage and adequacy of social protection, especially towards the self-employed and those in the informal sector, must be strengthened. On the outlook for 2022, Muhammad Afzanizam notes that a rising interest rate environment would help the EPF's revenue from fixed income and money market instruments, as the issuance of new bonds would be pegged at a higher rate, which translates into a higher coupon rate. Sime Darby Plantation announced today several changes and improvements to its governance structures, policies and procedures, which include the planned reimbursement of recruitment fees to its current group of foreign workers. SDP will also establish an improved responsible recruitment procedure to ensure that its operations are free from the scourge of forced labour. Group MD Muhammad Helmi Othman Bashar says that since the imposition of the withhold release order by the US Customs and Border Protection in December 2020, SDP has undertaken comprehensive audits, both internally and with independent organizations. He says that the company is taking today's challenges as an opportunity to create a positive change. SDP will reimburse 15,078 current foreign workers with an aggregate sum of 38.55 million. Additionally, SDP is setting aside a sinking fund amounting to 43.47 million to reimburse 19,564 former foreign workers. SDP is also engaging law firms in each country of origin for its former workers to manage the disbursement of funds, with the full cost of the legal firms to be borne by SDP. The sinking fund, established for former foreign workers, covers those who had worked for the plantation giant since November 1st, 2018. SDP said its former foreign workers were from Indonesia, India, Bangladesh, Nepal, Myanmar, Sri Lanka and Cambodia. According to SDP, the company has committed to ensuring zero recruitment fees for foreign workers since 2017 with the implementation of its Human Rights Charter. However, in light of the fees foreign workers have had to pay, which were unknown to SDP, and despite the existence of the zero fee policy, SDP says it has revised and developed a more robust system covering the entire process of appointing recruitment agents in collaboration with independent migrant worker rights specialist Andy Hall. Sapura Energy's share price slipped half a cent or 11% to hit an all-time low of 4 cents before it pared losses and closed unchanged at 4.5 cents. The stock was among the most actively traded counters, with some 88.2 million shares changing hands, more than twice its 200-day average volume of 34.2 million. On Monday, Sapura Energy said 5 of its wholly owned subsidiaries have been served, winding up petitions from separate petitioners in relation to unpaid contract sums, settlement agreement sums and judgment sums, totaling some 47.5 million ringgit. The group notes that none of the subsidiaries are major ones as defined under Chapter 1 of the main market listing requirements. Sapura Energy adds that the group and its subsidiaries are negotiating with the respective petitioners and have engaged lawyers for advice. The oil and gas player says that pending the outcome of the negotiations and receipt of such legal advice, there will be no immediate material financial and operational impact and no expected losses to the group arising from the petitions. Though Pharma Biotech saw its fourth quarter net profit slip 2.9% to 15.7 million from 16.2 million a year ago due to challenges from higher costs. Revenue for the quarter rose 8.5% year-on-year to 145.4 million ringgit. The group also declared a second interim dividend of 1.8 cent per share, adding that shareholders may elect to reinvest their dividend in new shares. For its full year report card, net profit increased 12% to 65.7 million from the 58.6 million posted the year before, while revenue likewise grew 12% to 639.2 million ringgit. Moving forward, Group MD Leonard Arif Abdul Shatta says that despite the operational and cost challenges, the group is confident of its long-term prospects as it believes the demand for healthcare and pharmaceutical products will continue to grow. He says this is evident in the government's increased allocation for the healthcare sector in Budget 2022. Leonard Arif notes that several developments are set to bolster the group's earnings in the upcoming quarters. This includes a 375 million ringgit tender accepted by the government for the supply of insulin recombinant human formulations to the Ministry of Health for 3 years through December 2024. In addition, the contract to supply pharmaceutical and non-pharmaceutical products to government hospitals and clinics have been extended for 12 months until end 2022. Sultan of Brunei, Sultan Hassan Al Bolkiah, on Tuesday welcomed the proposed implementation of the vaccinated travel lane by air to ease cross-border travel between Brunei and Malaysia. The ruler says he believes that the move would contribute to the economic recovery of the two bordering countries and hopes that the cooperation could be expanded, especially with Sabah and Sarawak, in enhancing trade connectivity. Prime Minister Datuk Seri Ismail Sabri Yaakob in his reply speech said the close ties between Malaysia and Brunei had opened the doors for cooperation in various fields, including trade, health, defense, and tourism. Ismail Sabri is currently on a 2-day official visit to Brunei Darussalam, his first visit to the country since his appointment to his current office.